In 1929, the world learned how fast prosperity can turn into panic. One day, Wall Street was unstoppable. The next, it was rubble. Fortunes vanished overnight. Banks locked their doors. Millions lost everything. Most people think it was a one-time disaster, a tragic chapter, closed a century ago. But what if it never really ended? What if the same forces that caused the Great Depression are quietly shaping your world right now? If you've ever wondered why prices keep rising, why housing feels unreachable, or why debt keeps growing faster than wages, you're not alone. What's happening around you isn't random mess, the echo of a system built on risk, greed, and illusion. Before we go deeper, tell me in the comments, where are you watching from, and what time is it for you right now? I love seeing how far these stories reach across the world. And if you enjoy content like this, make sure you subscribe, because today, S story will change how you see every headline about money, markets, and power. Now, let's go back to 1929. The world was riding a wave of euphoria. Stocks were soaring. Everyday people, teachers, farmers, mechanics were buying shares on margin, borrowing money to gamble in a market that only seemed to go up. Newspapers called it the new era of wealth. Sound familiar? Everyone believed the old rules didn't apply anymore. Technology was booming. Credit was cheap. Politicians promised endless growth. And behind the scenes, the same pattern was forming. Debt stacking on debt with confidence as the only glue holding it all together. In the years leading up to the crash, speculation wasn't limited to stocks. Real estate boomed, banks lent recklessly, companies overstated profits, consumers bought luxuries on installment plans. It was a culture of optimism built on borrowed money. And like every debt-fueled party in history, it ended the same way. Suddenly, in October 1929, as panic spread, investors rushed to sell, prices collapsed. Within days, billions in paper wealth vanished. The system that once looked invincible cracked open to reveal a hollow core. But here is the part that matters now. The crash wasn't the cause of the Great Depression. It was the symptom. The deeper illness was the structure of the economy itself. Too much debt, too little real income, and too much faith in rising markets. Sound familiar? Again? Today, we're seeing the same conditions play out, just with different names. Instead of ticker tape and telegrams, we have trading apps and crypto charts. Instead of margin loans, we have credit cards, mortgages, and trillion-dollar deficits. And the illusion is stronger than ever. Modern economies thrive on consumption. But consumption depends on confidence, and confidence is fragile. When people believe the system is safe, they borrow, spend, and invest. When they doubt it, everything freezes. That's what happened in 1929. And it's what economists fear today. The real danger isn't a crash itself, but what happens when trust disappears because when no one believes the system will hold, they stop playing the game. Let's look at debt. In 1929, household debt in the US had soared to unprecedented levels. People were buying cars, radios, and homes they couldn't afford, believing wages and prices would rise forever. In 2025, global debt is over 300% of total world GDP. The pattern hasn't changed. We're still spending tomorrow's money to live today. Back then, banks sold risky loans disguised as opportunity. Today, they do the same through complex financial products. The instruments change, but the psychology doesn't. During the 1920s, inequality reached historic levels. A small group of elites controlled most of the nation's wealth. Meanwhile, the working class survived on credit and hope. When the bubble burst, they had nothing to fall back on. Look around now. The top 1% owns more wealth than the bottom 90% combined. Corporate profits break records while wages stagnate. The middle class is squeezed, turning to debt to fill the gap. It's the same script updated for a new century. In the late 1920s, the Federal Reserve kept interest rates low to fuel growth, then raised them sharply when inflation appeared. The result, a sudden liquidity crunch that choked credit markets and triggered panic. Today, central banks face the same dilemma. Print more money to keep markets alive or raise rates to tame inflation. Knowing either choice has consequences. History is repeating in slow motion. And then there's speculation. In 1929, people poured savings into stocks they didn't understand because everyone else was doing it. Today, it's meme stocks, NFTs, and crypto bubbles. The psychology is identical. FOMO, greed, and belief in easy wealth. When prices rise, people think they're smart. When prices fall, they realize they were lucky. The Great Depression exposed one uncomfortable truth. When systems grow too unequal and too leveraged, they collapse under their own weight. The question isn't if, it's when. And if we're honest, most of the world's economies today are running on borrowed confidence. The signs are there. Record household debt, corporate defaults, and governments printing money faster than ever. But there's one key difference. In 1929, the financial system was smaller. When it collapsed, it took down millions. Today, it's global. A shock in one country ripples across continents in seconds. That makes the stakes much higher. What happened in 1929 wasn't just a financial failure. It was a failure of imagination. People believed prosperity was permanent. They couldn't see how fragile the system was. We're doing the same today, trusting central banks and politicians to keep everything stable. But stability built on debt and speculation isn't real. It's borrowed time. The lesson of 1929 wasn't learned, it was forgotten. Because every generation believes they're smarter than the last, that they've engineered a safer system, that this time is different. But the patterns say otherwise. The Great Depression started with a few bad days on Wall Street, but it ended with years of hardship, deflation, and lost trust. The danger isn't history repeating, it's us repeating history. And if the same forces are back, the question becomes, what happens when the illusion breaks again? In 1929, speculation was visible. Crowds gathered outside brokerage houses watching tickers roll. Today, speculation is digital. Instant trades, algorithmic bets, derivatives stacked upon derivatives. The speed magnifies fragility, and when sentiment turns, there's no time to react. Markets move faster than comprehension. The velocity ensures the next crash, when it comes, will spread before most realize it's begun. But perhaps the most dangerous parallel lies in psychology. Before every collapse, people feel safest. They believe in progress, technology, and control. They dismiss warnings as pessimism. In the 1920s, those who sold early were mocked. In 2025, those who speak of bubbles face the same ridicule. Confidence blinds, complacency builds. And then one day something breaks. A default, a failed auction, a sudden loss of liquidity, and the illusion evaporates. Yet history isn't destiny. The lessons exist. Diversify risk, question consensus, understand that value depends on trust, and trust depends on discipline. The system fails not when markets fall, but when people forget why they rose. In 1929, no one imagined a decade of depression. In 2025, few imagined the same. That's what makes the echo so dangerous. Familiarity breeds blindness. So as debt mounts, speculation grows, and inequality deepens, ask yourself, are we wiser than those before us, or simply repeating their mistakes with better technology? When the dust settled after 1929, it wasn't only portfolios that were destroyed. It was faith. Faith in the market, in leadership, in the promise that effort alone could secure prosperity. The collapse forced nations to reconsider everything they believed about money and power. The United States reinvented itself through the New Deal. It introduced regulation, deposit insurance, and social safety nets. These reforms didn't end the depression, but they slowed the bleeding and set new rules. For the first time, the state accepted responsibility for economic stability. Yet, even those solutions carried seeds of future fragility. Once governments learned they could manipulate markets for stability, they never stopped. Look at where we stand now. The foundations built in the 1930s still shape our present. Central banks create liquidity when panic hits. Governments spend trillions to stimulate demand. Investors expect rescue. The moral hazard is permanent. Risk is socialized. Reward remains private. In 1929, this would have been unthinkable. In 2025, it is assumed. This is how history drifts. From emergency measures to permanent doctrine, what was once exceptional becomes routine. The Depression taught leaders one clear lesson: deflation kills. When prices fall, people hoard money. Businesses delay investment and unemployment spirals. To prevent that, modern economies accept inflation as normal. But this tolerance has costs. Persistent inflation erodes savings, rewards debt, and punishes prudence. It shifts wealth silently upward from savers to borrowers, from workers to asset owners. The system now depends on this hidden transfer. It cannot allow prices to fall even when fundamentals demand correction. That's why crises today end with bailouts, not bankruptcies. Back in 1929, markets were smaller. The damage, though massive, was still national. Today, they are planetary. Capital flows move in milliseconds. Derivatives tie banks across continents. A policy mistake in Washington ricochets to Frankfurt, Beijing, and Sao Paulo within minutes. The interconnection built to spread prosperity now multiplies risk. When one link fails, contagion is instant. That's why small crises trigger global tremors. The structure amplifies every shock. The Great Depression reshaped geopolitics. Economic collapse fueled nationalism, protectionism, and conflict. Desperate populations embrace strong men who promise certainty. In our time, the parallels grow sharper. Economic anxiety breeds political extremes. Populism rises. Trust in democracy fades. When people lose hope in fair opportunity, they seek control. Any control. That was true in 1933. It is true now. The original crash began with belief that markets could self-correct. Today, we cling to belief that governments can always intervene. Both faiths are illusions. No system escapes arithmetic, debt exceeding income, speculation exceeding production, promises exceeding reality. These always resolve the same way. The longer the denial, the harder the reckoning. In 1929, few understood how intertwined finance and real life had become. A farmer in Kansas didn't see the link between Wall Street leverage and wheat prices. But when credit froze, his world collapsed. Today, the connections are more complex, but no less real. When central banks tighten policy, mortgage rates jump, housing cools, jobs vanish. The feedback loop is faster, the impact deeper. Ordinary people, not algorithms, carry the cost. Technology has changed scale, but not nature. In the 1920s, ticker tapes spread prices with delay. Today, algorithms act instantly without judgment. Fear and greed, once human, are now automated. This makes crises more violent. When machines detect a fall, they sell. When they sell, others follow. Liquidity disappears in seconds. What once unfolded over weeks now happens before markets open. The cycle has compressed. The consequences remain the same. But there's another lesson from 1929. One of resilience. Out of ruin came reform. Out of despair came innovation. The challenge for our generation is to adapt before collapse, not after. We know the warning signs: unsustainable debt, inflated assets, inequality, overconfidence. We also know the tools: fiscal prudence, productive investment, shared prosperity. What's missing is will. It's easier to postpone pain, to borrow another trillion, to print another rescue, but every postponement compounds the reckoning. If you study 1929 carefully, one theme repeats: denial. Journalists dismissed the first drops as healthy corrections. Politicians called it temporary turbulence. Bankers insisted fundamentals were sound. By the time they admitted the truth, it was too late. The system had already cracked. That psychology and the refusal to believe is timeless. It surrounds us again. Market optimism remains high. Valuations defy gravity. Central banks assure stability, yet beneath strain builds. When future historians study our age, they will ask the same question we ask of 1929. How did they not see? The answer will be the same. They did. They chose not to believe. Comfort is easier than correction. That is the core lesson of every crash. So where does this leave us? The global economy stands at a familiar edge. Growth slows. Debt climbs. Inequality fuels anger. Institutions strain. Technology accelerates everything. The pattern is old. The context is new. The Great Depression taught that collapse is not only financial, but moral. When trust erodes, systems crumble. The challenge today is preserving that trust before another reckoning forces renewal. If you followed this far, take a moment. Look at your own economy, your savings, your prices, your opportunities. The ghost of 1929 isn't in history books. It's in every decision to chase profit without foundation, to ignore warning for comfort, to treat speculation as growth. Crashes don't emerge from nowhere. They grow quietly in belief. So ask yourself, if the conditions of 1929 returned, would we notice? Or have we built a system so complex, so confident, that it can no longer see its own reflection? The answer may decide whether the next decade repeats the past or finally learns from it. If this made you think differently about the world's economy, share your thoughts below. Because understanding the past isn't nostalgia, it's survival.